Hello, good afternoon, everyone. Warm welcome from the enmacc offices here again in Munich. Yeah, we put down the lederhosen to be back here on video. We have quite some distractions ongoing, but nothing keeps us from having another Digital Traders Summit episode with you. So thanks for joining us today. On time with a new gas year, we want to go back on the gas side of the business after multiple episodes more around carbon and the electricity markets. There's as well exciting, I think, developments in the gas market, which we want to dive into. We invited the Argus Media team today to join us. So with two speakers, it's a new thing, a new kind of setup for us as well. So Lawrence and Natasha joining us. Warm welcome. As always, I counted your participation as well. So we have again the chat functionality where you can, add your questions, and I will pick them up for the Q&A session we have after the presentation. And we will have as well, as you see in a second, prepared a poll. So because we cannot basically pick up all the questions, we want to have everyone participating in this question. These questions in the poll are the opportunity for all of you to contribute to this session. Enough of an introduction. I'm handing over to Lawrence. He's VP at Argus Media for the gas and power markets. And yeah, he will introduce as well his colleague Natasha Fielding. She's an editorial manager for gas, LNG, and biomass in the Argus Media team. And they will share their presentation with us before we go into the Q&A. Thanks a lot. Lawrence, floor is yours. Don't you?
Thank you very much for the introduction, and thank you for enabling us to join your webinar today. It's a really wonderful pleasure to join you online. I'm looking after Argus business development activities for power and gas in Europe. And as Jens mentioned, we've put up some polling questions. I'm not going to read through them, but we're certainly very keen on hearing some of your feedback on these questions as we run through some slides and talk about some of the supply and demand fundamentals currently affecting the European market, and break out the discussion more globally into a view on global LNG and the implications for some of the familiar acronyms in Europe when it comes to market areas. Natasha is going to start the presentation today. So without further ado, I'll hand over to her to share some slides and begin the presentation. Natasha, thank you so much. I'll hand over to you and speak with everyone a bit later on.
Great, thanks very much, Lawrence. Can everyone see the slides? Mm-hmm. Great. So yes, Jens, you, along with everyone participating here today, and even our friends and families, will know all too well that the European gas markets have been through very turbulent times in the last 3.5 years. But we've also heard in that time that a turning point is on the horizon, that Europe must make it through potentially one more difficult winter before a large build out in LNG export capacity realigns the global markets and brings down prices. Have we reached that turning point? Is it even possible to reach such a turning point in a post-2022 gas market, which has lost so much flexibility? That is the real focus of our time with you today. So what I'm going to do firstly is have a look at what recent prices at the Dutch TTF gas hub tell us about the situation. Then we'll look at under what conditions we might see a return to volatility in the European gas market. And finally, we'll take a broader look at volatility from a global perspective. So this chart, which shows you the full history of Argus assessments of the TTF front month gas contract, really tells you, I would say, there are two kind of headlines from this. Firstly, it is clear that we have exited the 2022 crisis period when prices spiked to force a reduction in gas demand from all sectors and to really attract as much LNG as Europe could physically absorb. And secondly, that while prices are much lower now than they were, they are still higher than at pretty much any point since before mid-2021. That being said, if we zoom into the more recent picture, we can see that prices have been pretty stable for several months now. You'll just see a small blip out of that circled area on the right, and that's from mid-June when European gas prices briefly rallied over the Israel-Iran conflict. But let's zoom out a little bit to see what that period of stability means in the broader context. So here we have just the volatility index for the TTF expressed in percentage terms. And we can see that actually recent price volatility has been at its lowest since 2019. So really in the broader perspective, we are seeing a calm in the market. And this, for me, is a great barometer of just how balanced the gas market is. So we can see here the TTF price in red compared with gas to coal fuel switching levels. So we see that in times of market tightness, the TTF price jumps above the coal to gas fuel switching threshold to conserve gas demand, and then at times of oversupply, gas prices drop into that coal to gas fuel switching territory. This has historically been an important balancing mechanism for the market. And we can see that right now, and also based on forward gas, coal, and emissions prices, we are deep in gas to coal fuel switching territory, which is another sign of a balanced market. So why are we seeing this stability, and will it last? Well, this recent calm in the market is despite the fact that underground gas storage inventories in Europe have entered October at their lowest since 2021. You might think of storage as a bit like a security blanket for Europe, and we have that security blanket is that buffer is lower than in previous years. But actually the situation is brighter for storage this winter than it would have seemed about 6 months ago. And here I'm going to zoom in on Germany, which has the most storage capacity in all of the EU. So in Germany, at the beginning of April, a large share of the capacity was not reserved. So that's over 100 terawatt hours, which is roughly 100 LNG cargoes worth of unbooked storage space. We had seen summer-winter price spreads inverting last winter, which destroyed the incentive for traders to book and fill storage. But we saw those seasonal price spreads normalizing in the summer. We saw uptake of capacity, and we saw fuller German stocks today than many would have anticipated. Another part of the picture to understand this recent lower price environment is weak gas consumption really across all sectors. So in the power sector, the build out of renewables is cutting into thermal generation. In industry, we've seen higher gas prices than in the pre-crisis period, as well as a weak global economy, reducing gas-intensive manufacturing activity. And in households, we've also seen weak demand. And I really just want to pause on that sector for a moment, because I think it's a bit of an underplayed aspect of how the European gas market has changed in the last few years. So here, excuse the focus here on the UK. It's because there's good data for it. I've compared here household gas demand since 2022 versus the UK National Gas's composite weather variable, which is basically a wind-adjusted temperature. I've looked at it since 2022, and then I compared that relationship to the pre-2022 period. And we can see that households are using less gas than they were before at the same temperatures. And this is really down to higher energy bills. It's down to energy efficiency measures and the build out of heat pumps. Many would have thought that that relationship would have reverted by now back to the pre-2022 norm, but it has not. So here we see, and this is really a big explanation for why prices spiked back in 2022. There's been a huge reduction in Russian pipeline gas deliveries to Europe. I also think this is part of the stability picture now, because now that there is little Russian gas left in the European system, the influence of that uncertain picture for Russian gas on prices, on volatility, is less than it was before. And we also see that I've put in here domestic gas production in the Netherlands and the UK. There has been a huge decline in flexible domestic production, but in the last couple of years, that decline has slowed down. So far, I've given some of the answer as to why we've seen stable prices, but really the large chunk of the reason lies with the increase in global LNG export capacity. The year-on-year increase this winter in LNG supply globally is expected to be about 27 million tons. That's over 6 times higher than the previous winter. And the large majority of this is going to come from the US Gulf Coast, where also beyond this winter, there are large increases coming in the next couple of years. And it's not just that global LNG supply has increased. Europe has also been competitive for US cargoes against Asian buyers. So here we can see the blue band shows the Northwest European delivered LNG price versus the delivered LNG price into Northeast Asia. It factors in the difference in transport costs for a US cargo delivery to Europe versus Asia. And it's basically looking at where offers the higher returns for US cargoes. Is it Europe or is it Asia? It's been Europe, so the top half of that chart for most of this year, and therefore Europe has attracted the majority of US LNG cargoes during that time. That's the red line. And so far I've really focused on Europe, but this picture to really understand why Europe is attracting those cargoes and not Asia, we have to consider that there is weak demand outside of Europe as well. In China, we have seen, and this graph here shows the year-on-year changes in the balance. We see sustained higher domestic production, higher pipeline supply, particularly from Russia, and in combination with that, weak demand growth cutting into LNG import needs. This winter, Chinese buyers may well not need to enter the spot market at all. And elsewhere in Asia, in Japan, and also in South Korea, we've seen strengthening nuclear power, generation availability, cutting into the need for thermal generation. This has been the state of affairs really so far this year, but in a European gas market that's now reliant on securing spot LNG supply, there is going to be that element of uncertainty and that volatility because Europe's now exposed to global market fundamentals. And here I want to hand over to Lawrence to go into more detail.
Thank you very much, Natasha. We're now going to turn to some of the local dynamics in the European market in relation to this global picture that Natasha is beginning to build out here. And really, I think the key point that she's made is Europe's reliance on spot cargoes, if you like, in the global LNG market. We've seen the LNG market change as well in recent years, and we'll talk a little bit about that in the next slide. I'm going to rely on Natasha to jump over slides, so forgive me if there are some next slide, please, comments. So let's have a look at this now global LNG market. Let's take a step back and talk about what one can price within it from a spot market perspective. We're familiar with the TTF, European gas hubs, but really increase in trade in the global LNG market is still relatively new. First, just the observation that recent surveys that have been carried out among large LNG market participants have indicated that an increasing amount of global LNG supply is linked to natural gas or LNG prices. In other words, we've had a shift away from the relationship between the value of an LNG cargo and the value of oil, and a shift towards the value of gas on a purely gas supply and demand fundamentals basis, spot supply in the market. And of course, as Natasha's already shown, we've seen increasing volume coming out of the Gulf Coast and elsewhere. Much of this volume is freely available as soon as it's on the water. There's a reduced amount of destination requirements baked in to some of the agreements that govern that flow into the global market. And that means that the LNG really can go anywhere. It also means that the likes of Argus and others can price gas on the water globally, identifying sources, if you like, of net demand, net supply. So everything from your US Gulf Coast FOB on the top left-hand side of the picture here, all the way through to your Europe destination markets, and then, of course, destination markets in Asia. Now, having said all of that on the LNG side and the market structure, if you like, let's begin to look at the relationship between different kinds of flexibility in the global economy and why this shift over to LNG matters so much for Europe. First of all, we're going to start with a kind of trusty variable that many of you will be familiar with, European stock fill at the beginning of different storage seasons, different storage years, running all the way back to 2019 to 2023. That number there is just showing you the extent to which European gas stocks had been filled already at the beginning of each injection season. That's an indicator then of demand side for the coming summer from a storage perspective and the potential availability of supply in a coming winter. Moving forward, we can overlay on top of this picture of the physical fundamentals of European storage flex, a view on the relationship between the spot price that's achieved in Northeast Asia for LNG and the spot price that's achieved in the European pipeline market. And what we begin to develop is a view on the relationship between different kinds of flexibility asset across a global economy, despite, of course, our analysis beginning with a variable that is European located natural gas storages. I was trying to come up with a name for this earlier, and it seems most suitable to describe the graph at this stage as the sort of flexibility fish of LNG versus European gas storages. But it does begin to break down a little bit, as you'll see in the next slide. When we move into 2024, you would expect higher storages than a year earlier to reduce potentially the correlation as there's less requirement for injections in Europe for that particular summer, and cargoes can go elsewhere. But actually, with the addition of new LNG on the water, we potentially see, if you like, more inverted commas globalization of the gas market, despite the relative unavailability of storage-linked demand in Europe that summer. More recently, Natasha has gone through the fundamentals on the current state of play vis-a-vis demand in the global economy, and so we see a relatively weaker correlation as well so far this summer. As we move into the winter, it remains to be seen how that will develop. I'm going to hand over a bit to Natasha to talk about the extent to which European storage can be flexible before moving on. Natasha.
Yeah, thanks, Lawrence. So storage has been and will remain the biggest flexibility asset for Europe, but there are limits to that flexibility, which we have tested over the years, and usually that's down to unusual weather patterns. So I'm just going to go through a couple of kind of case studies of when we reach those limits. And the first one, which is on the left-hand side there, is 2018, the beast from the east that some of you may remember. We saw low underground storage levels across Europe, and then it got very cold first in late February to early March. We saw a big jump in storage withdrawals to meet that demand. And then it got quite cold again in late March, but by that time, there was limited gas left in some of storage sites across Europe. So towards the right of that graph, we see less of a responsiveness, quite weak withdrawals despite cold weather, despite a price incentive to withdraw. And then on the other hand, on the right-hand side, we have an example of when Europe struggles to absorb the global market's spare supply. So in September and October 2023, we saw that storage across Europe was already getting very full. And by mid-October, despite really wide storage spreads, we had a weak demand across the world, limited space and storage, and so actually we saw weak storage injections despite a strong incentive to inject gas into storage. I'll hand back over to you there, Lawrence.
Thanks, Natasha. So we've looked, if you like, at storage flexibility, both from a demand and supply perspective. And we're kind of asking the question, if you like, where's the gas burn going to come from this winter, given the fundamentals we've already discussed? Of course, weather conditions to one side, we have another source of flexibility, as Natasha mentioned, with her analysis of the coal to gas switching profile in Europe earlier. And that is, of course, the power sector. Will it burn gas? Where will it burn gas? When will it burn gas? Then maybe is one of the questions we should be asking if we're looking to understand some of the local dynamics in Europe before once again we branch out to the global LNG economy. We'll start with an analysis of the Italian versus the German power sector gas demand picture. And what we've got here really is a view of the generating margins for 55% efficient plants for this winter in these two very big gas burning economies. This picture indicates, of course, that Italy will certainly burn gas this winter based in the power sector, based on prevailing sparks. Germany kind of might initially, if we looked at trading activity throughout the first half of the summer, but then certainly towards the more recent month, we can indicate that Germany probably will. Now, of course, this has implications for where market participants may have hedged their gas, may have bought their gas on a forward basis. It will be very different in those two economies, and we'll talk about that in a bit more detail now. So we've got our picture on our forward spark spreads, if you were optimizing your plant on a forward basis, but let's have a look at how much volatility there has been in historical winters for power sector gas demand. How much, if you like, gas demand has been called on by the power sector on a short-term basis. We can see that in generating margins based on day-ahead prices. Let's start with Italy. Well, that blue mess, if you like, on the top right-hand side of the screen is showing you the highest and lowest generating margin on a very short-term basis for Italy, running a 10-year range, actually. And as you can see, in general, we see very short-term positive spark spreads all the way throughout any given winter in the Italian market. But if we turn to Germany, the picture is somewhat different. German prompt generating margins are very, very mixed. We see days when we have very positive sparks, days when we have very low sparks. And so in an environment when we have on the left-hand chart, will they, won't they, for forward hedging on an economic efficient basis, a gas-fired plant in Germany. And then on the right-hand side, an indicator that historical winters have shown us gas supply can be called on to balance the power market. We may be looking at a very different picture when it comes to the way that any of this will have been hedged. And indeed, if we look at positive generating margin days in the case of the PSV, that's the Italian market, and in the case of the THE in Germany, German Virtual Trading Hub, we see a very different picture. German positive generating margin days for 55% efficient plants have been reducing each winter over recent years, and we see less than 100 positive generating margin days last winter on that basis, compared with almost every day being in positive territory for Italy. So with all of that said, what can we take away from this? Well, first of all, gas markets in Europe are still local insofar as they remain diverse in terms of some of the demand side dynamics that affect them. Procurement windows we've seen in different markets can vary greatly across both sector, if you're talking from a demand side perspective, and local market area, so physical location. So in general, then, we can conclude that there remains, if you like, a great deal of demand side capacity, so natural gas demand, in the situation that, number one, the price is right, or two, you have short-term inflexible demand, as demonstrated by Natasha with the weather examples, and as demonstrated here from the power sector examples. Moving ahead then, one might say, so what? Well, from a power sector perspective, actually, this is not a small amount of gas demand or flexibility requirement that we're looking at here. We've built out, if you like, a demand stack for Italy and a demand stack for Germany, looking at how much inbuilt capacity there is for certain types of flexible plant and what efficiency they run at. This should give us a sense of how much capacity has been priced into the market and how much capacity has not been priced into each market. If you turn to the left-hand side here, you can see the German break-even curve. So this is giving you a view on the efficiency rating that a plant would need to have in order to have forward bought natural gas throughout the previous summer on a market efficient basis. Of course, there are all kinds of variables that can change this, but we're working here on a market efficient hypothesis. Essentially, you're looking at pricing in around 51 terawatt hours of gas across the winter, and pricing out around 13 terawatt hours of gas across the winter. Turning to Italy, just to review the same metric, Italian plant, as you can see, there's a lot more of it, but it's in general less efficient than the German plants. Italian gas-fired plant breaks even at around 45% on a market efficient basis. This is taking into the market then on a forward basis around 277 terawatt hours of gas demand for the winter, right? Now, that gas demand, in theory, has already been priced in, which means that there's no potential for additional demand necessarily, but there's certainly potential for some of that gas to be shed from the power sector back into the market in the environment that the power sector does not require that flexibility on a short-term basis, because we now have so much inbuilt renewable capacity. Right, so that's a kind of very European regional story. And we're going to now set it back in the context of the LNG market and talk about why all of this matters in terms of volatility, where we can find volatility in the market and how it emerges, how it expresses itself. And to begin this, we've done this sensitivity analysis by essentially what we're looking for is, if you like, a demand side sensitivity and a supply side sensitivity over time. We'll start with our blue line here, which is showing you your coal to gas switching level. We're going to treat that for the purpose of argument today as your demand side flexibility in the European market. The more gas-fired power plant is competitive against coal, the more you would expect it to be exposed to renewables, the more you would expect it to be switched on when called for by the power market. So next, we have, if you like, your supply side approach. This one is somewhat more controversial than the coal to gas switching range. But we're going to give the example of an oil switching price here. Now, what we've taken then is a differential to an oil price. Essentially, why we're looking at this as a piece of supply side flex is because, of course, there is still some oil index supply in long-term gas agreements globally, giving a bit of supply side flex. Second, the displacement of oil by gas in instances where the natural gas prices fall well below an oil index level. And finally, because of physical reinjection of natural gas in the environment that oil prices provide a greater return for the producer than natural gas prices. So we're going to see this metric as our supply side flex. Okay, so we've talked about supply and demand side analysis. Let's have a brief look at how volatility, not necessarily outright price, but the extent to which prices move has changed relative to those two metrics. And we'll start with our TTF day ahead volatility, the gray line here. We're going to overlay on top of that our TTF front month volatility, gas for delivery on a forward month one basis. And we begin to get a sense here that, of course, historically, you tend to see a little bit more movement in the day ahead market relative to the forward market, if you can call the month one forward, as a result of the day ahead market being affected by short-term physical fundamental changes. But let's look at this in two distinct eras. The first era is one in which we have relative market length. This is the period in 2018 through to mid-2021, when effectively Europe was calling on more demand, if you like, and we were moving through the demand stack until, some of you will remember, the European natural gas price actually fell more or less to the level of the Henry Hub price in the US. We then, as the market rebalanced, thanks to reduction in US flows into the global economy, having started in 2016, and then reduction in deliveries by the electronic sales platform of Gazprom Export, we saw the market tightening. This was a period of time when gas was relatively uncompetitive against coal. This was a time when gas was at a premium to any kind of oil index. The market was relatively tight. Now, this was a time when, if we run an analysis on volatility, we begin to see a process where the extent to which the day-ahead price in Europe is volatile and the extent to which the front-month price in Europe is volatile begins to fall in line, thanks to the reconfiguration of the market, thanks to the addition of so much LNG, as we'll discuss here. This is my final slide, just to explain what we've done here. Essentially, these bars are showing you a TTF day-ahead price and a TTF month-one price as an outright average for each calendar year, 2016 to 2025. Those averages, of course, as one would expect, are broadly the same. In other words, the price that's realized in outright terms, TTF price for your forward month delivery, the TTF price for your day-ahead delivery, is broadly the same if you take a whole year average prices for each of those different markets. However, the volatility for each of those markets, the day ahead and the month one market, has behaved very differently in the past. If we step back to the days when we saw a lot more less LNG in the European supply mix, it's behaved very differently to more recently when we see a lot more LNG in the European supply mix and have that global exposure to supply and demand fundamentals that we've touched on today. The bars on the top here are showing you relative volatility for the day ahead price versus the month one price, expressed as a percentage. For those of you who are interested, it's a 21-day rolling average. And as you can see, if we move to the far right-hand side of this graph, we begin to see a picture where actually the volatility for the day ahead market, the volatility for the front month market is broadly moving in line with the day ahead market. And what we're proposing here is that this is a function partly of the fact that regardless of whether you require short-term gas to be bought or sold, if you're a power plant, very local dynamics as we've discussed, whether or not there are changing weather conditions from a European market perspective or potentially Northeast Asian market perspective. Because LNG cannot be bought and sold and ramped up on a day ahead basis, but rather on a month one basis, we begin to see some of the requisite volatility that would ordinarily be located in a day ahead market leaking into the month one market, either as cargoes are shed because the market is long or procured on a shorter term basis because the market is short. You can get an LNG cargo into a terminal maybe next week or the week after, but you won't be able to get it into a terminal tomorrow if you need it. So that's everything from us for the time being. I'm going to hand back to Natasha briefly to run through some conclusions before we go to Q&A.
Yeah, thanks, Lawrence. So just very briefly to sum up, we have seen we've seen a big fall in price volatility recently, but that does not mean that we won't see volatility to come. Now that the European gas market is exposed to global fundamentals, now that the gas markets are globalizing, there is still great potential for volatility to come, particularly in a European power sector that is decarbonizing. I'm going to stop sharing my slides now so we can have some discussion.
Yeah, wonderful. Thanks for the presentation. I mean, a real deep dive here into the volatility matters. Asking back again, what you want to start with a poll now, right now? I see it already. Yeah. Everyone jumps on it. All right. Directly leave it to you, Natasha, to comment on what you're seeing here.
Let me see if I can find. You might have to remind me of what the results are.
Can you see them on screen, or you don't see them right now?
I cannot.
Ah, you cannot. All right.
Or maybe Lawrence can comment if he can see them.
I think we are just getting some poll results through now, Jens.
Yes, yes.
I see them now. I see them now.
Can you see them, Natasha? Maybe
Yeah.
I'd be happy to run through the question.
All right, good.
Okay, so the first question that we looked to posit was really on expectations on Russian gas deliveries to EU customers beyond 1st of January. Of course, been posited as a potential deadline for the cessation of Russian flows. It's a question that we are keen on hearing feedback on. So far, we seem to have seen, based on this poll at least, that only 13% of people are expecting more Russian pipeline gas and LNG than today, while no Russian pipeline gas at all is around 22%. Of course, there are questions around the availability of capacity to deliver that gas and how it could be managed, which may be something we can look to discuss in more detail.
What is your expectation at the moment? What is your perspective on how much has been priced in regarding Russian volumes for this winter before we jump on the next one?
Yeah, so in terms of this winter, this will be the first full winter without Russian gas transit through Ukraine. The Turkish Stream pipeline route to Europe is the last one standing. As things stand, it doesn't look like much will change this winter, that we'll still have Turkish Stream running close to capacity. It was running at 95% of capacity in the first quarter of this year. So the picture looks fairly stable, but who knows what could happen.
But the LNG volumes are as well significant right now. So I think there's a new debate around that, or as well political expectations to stop that. Do you expect that to continue as well?
Yes, indeed. The LNG question is an interesting one. We're still seeing a lot of Russian LNG being unloaded in Europe. The EU does plan to introduce sanctions that will ban Russian LNG and pipeline gas. I think the latest is that the EU wants to introduce that ban on LNG as soon as 2027. It remains to be seen what and when that ban will be implemented.
So summarizing, still, we want to get into safe territory regarding supply from the US, and then we can be a little bit tougher on the Russian supply. Yeah.
Exactly. I think that the timing there is a really important aspect, because it would be much more straightforward for Europe to really banish the last Russian molecules from its system in 2 years' time versus a few years before that, for sure.
Mm-hmm. And our participants are already rushing ahead here. Good participation. Thanks a lot. To the second question, Lawrence, maybe this requires a little bit more of interpretation or commenting on. Yeah.
Certainly, yeah. So this is another question that we commonly seek feedback on when we're discussing with market participants what's going on. I think just to summarize the question for those of you who can't see it, the question is essentially around what the main drivers of volatility are likely to be, which is the main theme of our presentation today. It's fascinating, really, that the feedback around this sort of question is quite often around 53% here on geopolitics, market sentiment. In that respect, if you like, some of those hard and fast rules around the European physical market seem potentially to be seen as less impactful in terms of volatility than harder to quantify changes that can take place in the market as a result of very significant shifts in government policy. And of course, you know, as Natasha mentioned earlier, we have seen significant volatility on a short-term basis very recently as a result of market sentiment in Europe around escalating conflict in the Middle East.
Mm-hmm. I mean, you discussed the volatility of the day ahead and then the month ahead.
Yep.
With contracts aligning more. Is there a relation to the news flow changing as well from very short-term oriented events to more midterm perspectives? Does that play a role?
So I'll take a first shot at that. So in terms of news flow, yes, the midterm implications of some of the kinds of information that we receive from the market, particularly from the geopolitical side, seem to be more obvious than the short-term implications from the geopolitical side. So one could argue that if we're looking at potentially volatility on a month-one basis and we care about cargoes for flexibility and not pipelines turning up and down, then yes, the implications of new information are felt more in a market that is ultimately dependent on the procurement of cargoes that will arrive in a few weeks, rather than a pipeline that can turn up or down supply within a matter of hours. Natasha may have something to add to that.
No, I would agree with that. I think a lot of the if you like, headline-driven price movements have been affecting not the day ahead, but from month one onwards. If that's around, you know, the outcome of negotiations around the end of the war in Ukraine, that the expectations of that affecting supply into Europe cannot be on the prompt. So I think that's another explanation of why we are seeing volatility shifting into the forward market.
All right, but that maybe going last question on the last poll here. If we still see the power markets as one big influencing effect on volatility, having seen your analysis, I think this deeper analysis could lead me to the conclusion that there shouldn't be so much volatility ahead, as this follows certain well understood rules and market patterns in your analysis. So isn't that a part of the risk or volatility, so to speak, we may take away as market participants, that this is maybe an overestimated driver of volatility this winter?
Yeah, so from the power market perspective, just to take a step back, I think the questions that we receive most commonly from people in the market are, to what extent do you expect to see growing cannibalization? Is a term that's very often used as a result of additional renewable capacity, particularly solar, less relevant in the winter. The fact is that while we can run analysis based on our expectations of the impact of renewable build out on thermal gas demand, if you like, or thermal electricity demand, so from a gas-fired source, it remains to be seen the extent to which those new capacity build-outs will affect that. And of course, the more that we have this intermittent capacity available that's inflexible, wind and solar, the more that gas is called on potentially to step in to bridge the gap and to balance. That's not to say that there's necessarily more gas demand overall, but that the demand profile for natural gas from the power sector could become increasingly choppy, and of course heavily dependent on weather, which is a factor that we can only know relatively shortly before the event. And if we're dependent on weather shortly before the event, but the gas supply chain is global, and you're going to have to buy or sell an LNG cargo as a result of, for example, wind farms not operating, then potentially, again, from a volatility perspective, we'll see a lot of communication between your short-term pricing and your forward pricing potentially.
So we'll move to that. Yeah, we're moving on to poll 3. Thanks for the great participation. I love seeing this interest here and sharing your views. Are you surprised by this? Less volatility peaking here, but wider picture, more participants leaning towards the other side, meaning more or broadly unchanged?
I think this reflects rather well the conversations that I have with people in the market. People have quite mixed views. Some are really seeing, that build out in LNG capacity really leading to a less volatile market from now on. Others have taken a view that the market is underpriced and that we may well still see return to much higher price levels if we get a cold winter, if we have the unexpected happen, if there is actually real competition for LNG supply in the Atlantic basin. We cannot rule that out. So I think that survey quite nicely captures the mixed views from the market at the moment.
Interesting. Very good. Yeah, so broadly, I think some of the topics, if I recall a little bit, those conversations we had over the last years were much more around, Asian demand, driving the market. What we have not touched upon, but became recently a bigger topic, is what about demand in the US, and what about the balance of US production and as well kind of US consumption needs, specifically for energy production. Is this a theme we'll see more in the future?
I certainly think that's a theme that we will see more in the future. There's an interesting convergence going on in global markets at the moment. We're seeing your TTF price and Asian LNG prices falling. At the same time, in the US, there's a large build out of LNG export capacity, which is adding more demand to the domestic market. That's on top of the build out of data centers, which is also increasing demand. So there are some questions as to whether we'll see price increases in the US, and certainly it seems likely that we'll see greater convergence around the globe. So it will also be and has become more relevant for European and global LNG market participants to be taking a closer view of what's going on in the domestic US gas market.
That was my impression as well, with especially as well politically emphasized this or escalating discussions we have there in the US, which may have a bigger effect. And then provocatively, we still talk about a global market, but we have some regionalization effects as well. Not worth to mention the Russian Chinese deals right now recently. Is this a fundamental change to how we have to view the market, or is this just happening at the fringes of the main streams of LNG across the world?
I would say so. In the case of US tariffs on China, and in the LNG market, this is actually an example of how globalized the market is. So we've seen that China has not been taking any US LNG. Instead, those cargoes are going elsewhere. And so in terms of global trade patterns, we've seen a change. But in terms of the overall availability of LNG for the world, there's not been that much difference. So that's kind of an interesting aspect that we also saw under the previous Trump presidency.
All right, very good. I would like to pick up one question a little bit in general terms. What is the role of storage in the future? Do we have a higher need for storage in Europe? We've seen that we are not at the same levels currently as in previous years, specifically not in Germany. But taking at maybe a more midterm perspective, the relaxing situation on the LNG market, but still the high level of volatility, what does it mean for storage?
Yeah, so I think it's an interesting question. On the one hand, there's a question of, do we need more storage? Do we need more flexibility? And certainly we've lost a lot of flexibility from the European gas market. But I think there's also the question of, besides do we need that, will we actually in fact see a reduction in storage capacity in Europe? I mean, we've seen in Germany and also elsewhere, it was a real struggle for market participants to book and fill storage. There's a big chunk of capacity at slow cycling facilities that was not bought. Summer winter spreads are narrow for the coming years. So there's for me, there's a question for the next year, and I think it will be a big topic of whether we'll see storage site closures. which could help to widen summer-winter price spreads again.
Okay, so you would expect that due to the low profitability we see of some of the sites, yeah.
I'd say unless something changes, we also know that there are already some plans in place for Northwest European site closures.
Just to add to that, if you don't mind, Jens, just briefly, in terms of the storage picture, but perhaps there's an analogy with LNG, not only because floating LNG, is now an option for the European market as well. In other words, LNG cargoes sitting off the European coast at times when they're looking to, if you like, manage deliveries into the European market when prices are higher before winter during the shoulder season. There's always been this question around new LNG contracts, particularly for new LNG market entrants on a national level, of how you look to structure a long-term LNG contract when you're at least meant to be looking to phase out fossil fuels over the next 20 to 30 to 40 year time horizon. And those commitments, the terms on flexibility will of course be highly dependent on the extent to which you're willing to commit to a longer time frame. There's potentially the same thing could be said for storages, where we've had over years this debate around, as Natasha has already said, really the intrinsic and extrinsic value of storages, whereby as summer winter spreads begin to tighten, the only way to potentially open them is to have less available capacity in order to create that incentive to spend a wider spread, if you like, on that intrinsic value of storages. So our experience has been that as capacity is utilized less, particularly in Central and Eastern Europe, of course, then the incremental cost of using that capacity increases. So that's another challenge that we'll have to figure out over the coming few decades.
Yeah, understood. Look, I have so many questions left on my sheet here and as well in the chat. I think we have to come slowly to an end. So I will not let you go without the key question. What about price levels? What do you expect prices to be in this winter? You want to share your view beyond volatility, what kind of level we can expect, where we are heading? Any?
I can give a slightly unsatisfying answer to this as a price on the price reporting side of things. I'm not allowed to give a forecast, and that's it's partly why we focus on this volatility question. It does seem like there is definitely upside price risk for this winter, but there's also a lot of downside price risk, and I think a lot will come down not only to the factors that we talked about just before, but normal dynamics like the weather will have a massive impact on where we see those prices at delivery.
Very good. No, thanks a lot. I mean, look, that's why I like this session a lot, that we focus more on volatility and some of the influencing factors there. Very good analysis, really interesting. Thanks for contributing to this session. It was amazing. Natasha, Lawrence, big thank you, really. Hope to see you soon again here, and we continue the discussion with the audience. Thanks everyone else to participate as well. I guess we come back with a new episode pretty soon. Nothing to be announced yet, but please follow the news on LinkedIn or in your email box, where we'll inform you about the upcoming topics. Thanks, everyone.
Thank you for having us.